Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The stock market has had a great start to the year, and there are a handful of really high-profile stocks that are up over 100% just in the first 2 quarters of the year. So I want to highlight 5 of those and see if we can learn anything from the trends that are going on, either operationally or from a market standpoint, from these 5 stocks. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And check out my newsletter, Asymmetric Investing, in the show notes below. I've also got a deep dive on one of these stocks down there, so I think you might be interested in that one. The first thing I'll do is show the chart of the 5 stocks that I'm going to talk about today: Spotify, Royal Caribbean, Carnival, Coinbase, and DraftKings. There's kind of a mix of everything here from businesses. You've got technology, consumer discretionary spending with the cruise lines, and then even a gambling company. So since it's first on the list here, the first one I want to talk about is Spotify and exactly what's going on with the company's stock and with results, what we have learned over the last 6 months. The first thing is that the number of users that Spotify has, both on its premium side and also its advertising supported tier, is really increasing rapidly. And I think this is one of the interesting trends in the music industry right now is Spotify is really consolidating control. They're really taking market share from Apple in particular in both music and in podcasting. There's still a lot of threats from companies like Google and YouTube, but Spotify seems to be in a really solid position in the music and audio business overall. The theory is if they can grow the number of users that are coming in kind of at the top of the funnel, then over time, they will both be able to increase advertising revenue. And also, a lot of those users are going to be transitioning to premium subscriptions eventually. The company has also done a lot of cost cutting. This is something that we've seen across the technology industry, but Spotify has really taken the last 6 months to a year to cut its operating costs and really focus the business on what it does best. So, delivering streaming services, providing advertising, and then being the discovery mechanism for people who are looking for new music or new podcasts. Where they really want to be is the center between the content producers and the content listeners. And that's what I think a lot of these strategic moves should really be viewed under. That's how we should look at these moves. And it seems that we're starting to see momentum in that area. The stock sold off since its peaks during the pandemic. So this is one of those kind of recovery plays from a market perspective. The market is taking a look back and gone, you know what, things are actually looking a lot better than we thought in late 2022, and that's why the stock is up. The next two are the cruise lines, so Royal Caribbean and Carnival. And I want to show a couple of charts here because I think these two are really an interesting case study in what is going in the market. You can see here that revenue has really recovered nicely for both Royal Caribbean and Carnival since the depths during the pandemic. That said, both companies are still losing money. That I think is something we need to note. So there's some bullish trends given the fact that revenue is up, bookings are up. It seems like revenue is going to continue rising over the next few quarters at least. And I know Carnival in particular, I did a video on this recently, is just pulling billions and billions of dollars in from deposits for future trips. But the challenge for both of these companies is that over the last 5 years, they've taken on a ton of debt just to survive. You can see here that early in 2020, both companies had less than $10 billion of long-term debt. That has exploded. Carnival has $33.7 billion of debt right now, and Royal Caribbean has $21.5 billion of debt. That's just a number that's not going to be sustainable if they're not able to generate a profit. And with rising interest rates, that could be a further headwind because when that debt does need to be refinanced, it's going to be far more expensive to refinance it than it was in the past. So the view from the market's perspective right now is that consumer spending is not nearly as bad as we thought it might be coming into 2023. Remember, there was a lot of predictions that there was going to be a recession this year. It doesn't look like that's going to be the case, at least not yet. And one of the beneficiaries has been the cruise line industry. People seem to still be spending a lot of money on cruises. That's the bullish sign. But long term, the thing that I think investors really need to think about is that going to be sustainable and can they pay down this debt? That's the question I have with those two companies. But right now, market seems to be overlooking that. The third stock on the list is Coinbase. And this has been a fascinating business to follow over the last year because there's been a lot of pressure on Coinbase's business. Revenue is down in most sectors of the business, particularly in trading. but it's starting to do much better in things like subscriptions. So things that should be growing long term. There's been a lot of benefit from the USDC token. That's the stable coin that Coinbase is a 50% owner of. The consortium that runs that generates hundreds of millions of dollars in revenue right now from that token. But the company has also been sued by the SEC for selling what they call securities to consumers and traders. So that's a piece of pressure on Coinbase's business. But ironically, Coinbase's stock has absolutely exploded since that lawsuit was filed in early June. So what the market's telling us is this is actually going to be a clarifying incident for Coinbase. Whether Coinbase and the SEC go through the court system and get clarity on what is and isn't a security from a cryptocurrency standpoint there, or whether this forces Congress to clarify some of these things. All of this is on the table, and that's going to be a benefit for Coinbase long term. At the same time, you're seeing other countries say, hey, we want to have blockchain development here. So the UK, Hong Kong, some places in Europe, there's starting to be real rules put in place so that innovation can happen on the blockchain. And at the end of the day, that's going to be good for Coinbase. So that's why the stock is up, even if we haven't seen great results on the bottom line quite yet. And the final stock in this group is DraftKings. This is another one that I think has really benefited from the fact that the economy is not as bad as a lot of investors thought it was going to be this year. That means that more people have money to spend on things like gambling. And the company continues to grow, continues to add new jurisdictions where it can offer its online gaming products. The problem is, as you can see with this chart, DraftKings still isn't making money. And this is the question that I fundamentally have about this company long term is what's the moat there? What's keeping a user from going to the next app where maybe there's an incentive to place a new bet or there's better odds? When competition is only a click away, that means that there's not a lot of moat when you're offering effectively the same product as somebody else. So in this case, a wager. So that's going to put pressure on margins. We have seen over time that DraftKings has to spend a ton of money on advertising to be able to attract its customers, and it's giving a lot of those customers benefits. And that's why we're seeing this weakness on the bottom line. $2.6 billion in revenue over the past year, $1.3 billion in losses. So this stock may be up, but I think it's up on speculation that there's going to be some sort of future growth. And we simply don't see a lot of evidence that the bottom line is getting much better very quickly. So there's 5 stocks that are up over 100%. I think the big takeaway here is there are some fundamental changes that are going on in some of these businesses. Operating costs are coming down in a lot of cases. Revenue is rising. Consumers seem to be relatively strong. The question for all of them is what is sustainable and what is not? And that's what I think investors really need to think about is some of these stocks are up huge, but are they going to be able to live up to those higher expectations? As I've highlighted here, I don't think that's going to be the case for everybody. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.